I'm Kim Brimmer, your host today for another edition of Bova News, keeping you up to date on the cattle industry's latest in technology, management, genetics, and more. Dairy producers are in the midst of another unique financial situation, with high milk prices coupled with high feed costs. There are a number of domestic and global issues that have led to this current situation, and it appears that this volatility will continue for some time. Today, we'll hear from a financial consultant to tell us how we got to where we are today and what the future holds in terms of making sense of the current dairy market. Presenter today is Curtis Gerrits. Curtis is a senior dairy lending specialist for Compeer Financial, serving dairy producers throughout Wisconsin and Minnesota. He works directly with dairy producers, providing full-service dairy lending relationships, financial outlook planning, and overall general dairy production business philosophies. Welcome, Curtis.
Hey, thanks, Kim, so much for the introduction, and thanks, Bova News, for having myself on board with this webinar here today to join Enrique, Jim, and Jake in some very important information as we navigate through these volatile marketplaces. On behalf of Compeer and myself, I just wanted to say again, thank you so much for having us on board here for the webinar. A couple of things that we're going to be discussing here in this portion is just kind of some areas of focus from the lending and financial side of your business. And what it relates to in a volatile marketplace. A couple of pieces that we'll be touching on is, first and foremost, is understanding your numbers for your business. Cost of production and cash flow. What are the two? Why are they different? And why are they important to understand? Working capital, especially in the volatile marketplaces that we're in. We're going to go through some ups and some downs. And having some working capital in your back pocket is going to really prove to have success for your dairy operation. Equity and collateral, we hear that name or those names being thrown around a lot. Where should they be for your farm? What is collateral? What do we need to understand about it? We'll touch on that here a little bit as well. Kind of coinciding with equity and collateral, we start to talk a little bit about balance sheets. Making sure that you've got your debt structured correctly. The loan structure, why is it important, and how do you structure that for success moving forward in tough times and in good times? Risk management. Jake with Everegg, they get to deal with this on a regular basis. But outside of hedging and looking at calls and puts and futures and things of that nature, what other risk management options are out there for your business? And lastly, working with your lender and professional team. How do you leverage them to be successful? So the first thing that we'll quick talk on is the cost of production. We all know that in the dairy operation, we've got lots of areas that we need to focus on. Enrique touched on it here a bit on, actually quite a bit on the feed cost side of things. 50 to 60% of your expenses that run through your farm goes directly to feed. It's a huge number. That number can be moved up or down if you got a really good handle on that number and what goes into creating that 100 pounds of milk for your dairy operation. The next two big ones that come into realm here is labor and replacement costs. 25 to 35% of your expenses are going to go right directly to that bucket. And then the rest of things, as we're going to look at cost of production and how do you equate that out, we're going to have other production costs, your other expenses, overhead, and some things that we need to back out of that is our cull revenue and some other incomes to really come down to see what our cost of production is. So when we start to look at what does that equation look like, it's essentially taking all of those items, backing out our cull revenue, our cull cows that we're selling either to market or selling for dairy, and taking out our other income, our beef sales, our grain sales, selling our calves and other young stock. Let's back that number out there as well. And I really enjoy how Enrique focused a lot on the energy corrected side of things and how important that is. Not just looking as to what you get paid for every 100 pounds of milk, but let's back that out and talk a little bit more about the true energy corrected side of things, all things considered. The farms that we work with on a regular basis that strive in the good times and in the bad times, especially in the bad times, have a phenomenal understanding of what it costs to make 100 pounds of milk on their farm. Can't stress enough how important it is to know your numbers in this area. Equally as important, cash flow. What's coming in, what's going out. On a monthly basis, you need to understand in the upper Midwest, when we've got a lot of manure maybe going out onto the fields in the spring, and we have a custom applicator that's putting it out for us, that's a good chunk of change that's going to have to leave the checkbook. At that exact same time, we're putting a crop in the ground. We're paying for fertilizer, we're paying for seed, we may be paying for other custom hire operations that are going to be stuck into our business. We need to understand how much cash are we sitting on, what's coming in, what other kind of income is coming in, our other income, our milk income, and again, what is going to have to go out. I got to make sure we manage that checkbook on a regular basis. To go along with that, it's a good thing to understand on a regular basis, but what do you need to do? Establish your budgets and business plans early and on a regular basis. I've seen a lot of producers that just kind of go through the motions. They put the numbers together because either they're asked to do so, or it's something that they've just always done. They fill in the numbers come January or February as to what the year is going to look like. They tuck it away, and let's face this, dairy farmers are extremely hard and diligent workers. They put all their effort out into the business, are out onto the farm, boots on the ground. That budget may not get reviewed again. It may just get put on the side of the desk. Make sure you're looking at it and understanding it. And if you need to adjust it and amend it because of what the market is doing or some of the other things that are happening on your dairy operation, make sure you visit it. Are there other areas of opportunity on your farm that that you may be able to hone in on to have a better impact financially on your operation? Feed, again, we're going to stress feed. 60% of your expenses go out towards it. Is there opportunity there to improve either milk production, milk components, or maybe even back down what you're putting into the rations? Is that going to have a positive or a negative impact on the TMR and overall milk production and profitability of your farm? Understand those opportunities. There's a lot of them. It's hard to focus. Every dairy business is different. So you're going to have to peel back the onion a little bit and see where those opportunities might arise on your farm. So the cash flow break even. This is what we're going to look at. All things considered, all of your expenses, when we call expense rate, all of the expenses. That's your feed costs, your labor costs, your rents, supplies, chemicals, all of the things that you got to pay cash for to go into your business. Labor's in that number as well. Term P&I, principal and interest. That's the true cash cost that needs to leave your checkbook. And then anything that is capital expenditures that you're going to pay for out of cash, whether that's replacing the motor in one of the old tractors, cutting a check for a new skid steer or something to that effect, something that needs to leave your checkbook. Any of those capital expenditures need to be considered as well. Understand that cash flow break even. Can't stress that enough. So working capital, we're going to shift gears here just a little bit. So we talk about working capital a lot. So what exactly is it? It's our current assets. It's the things that we can turn into cash kind of in a blink of an eye. It's going to be our feed. It's going to be the grain that we've got put up in a grain bin. It's going to be our cash. It's going to be our accounts receivable. It's something that we can turn into cash as long as we can get it collected. That can be a factor. We're going to take all those current assets and subtract our current liabilities. Our current liabilities could be our operating loans. It could be the crop note that we borrowed to put the crop in. And it could be accounts payable, monies that we owe out there yet. So we take our current assets and our current liabilities. That's going to spell out to be our working capital. That's essentially the excess cash per se that we can use to operate on a daily business. So we're going to back this up just a little bit and talk about current ratios. So we're going to take our current assets divided by our current liabilities. Anytime that number is over 1.0, that means we've got more current assets than we do have liabilities. It's a fantastic place to be. goal that we like to see out there is if you can be 1.5 or better on your current ratio, you should be sitting in a pretty good spot to be able to keep that cash flow going on a regular basis. We talk a lot about cash, and it's great to have the cash, but it's also great to have one of the other most, let's call it as good as cash, is the feed on hand. Having significant inventories or enough inventories to have some good carryover from season to season or year to year is going to prove to be beneficial. Let's all face it, we are, no matter where we're located, West Coast, East Coast, the plains, upper Midwest, we come into some high, high concerning weather times, whether it be droughts, excess precipitation, tornadoes, hail, things of those nature. Having that carryover of feed is very good thing. It's crucial, especially in those times when maybe our crop insurance payments aren't going to necessarily cover everything that we need to have sitting in the bunk. I've got this rule of thumb. In this volatile marketplace, like we're seeing right now, there's a significant amount of dairy producers that will likely have excess cash. What to do with that excess cash becomes extremely important. These are my rules of thumb that I work with every dairy producer. Number one, it's the obvious one. Make sure all the bills and invoices are paid. Keep everything current as possible. The second thing is paying down or paying off operating lines of credit or other operating loans. Set yourself up to succeed when the next time you need to borrow money. Having the availability on your operating lines of credit is going to be very crucial. When all of a sudden there's going to be an invert, when all of a sudden we're going to see milk prices decline, and maybe our other income or other expenses on the farm, especially feed, staying up high yet, we're going to see that some point in the future, and having that availability in that operating line of credit will prove to be very crucial. If there's still excess cash after operating lines of credit and operating loans, pay off your next year's input expenses, prepay. That's going to prove to be beneficial on your tax part of things, and it's going to set you up for a very successful next year in the event that we don't have the types of incomes desirable to have a positive cash flow. Capital lines of credit. If there's still excess cash, pay down those capital lines of credit so that you can be using those funds to fund the next skid steer, the next tractor, the next piece of equipment, updating your barns, parlor, so on and so forth. And then lastly, if there's still excess cash, which there could likely be, pay for capital purchases. Don't necessarily have to borrow the money. One thing that we will talk about, or what I will say, is that for the dairies that are sitting pretty strong financially, using the cash to go towards improvements on the dairy operation, whether it's updating the parlor, improving ventilation, some to that nature, and perhaps taking that along with borrowing money, we definitely will support that, especially if it's got a positive benefit to your operation and your cash flow can support those new principal and interest payments. We're going to touch just briefly on equity and collateral. Before we just go diving right into what equity and collateral is, before you know that, you need to prepare an annual balance sheet. Include schedules in each of the areas. And sometimes people may not understand, well, what's a schedule? For example, instead of just saying, well, I've got $1 million of feed sitting out on my feed pad, what does that mean? Break that down a little bit. How many tons of corn silage? How many tons of haylage? Do you have any cottonseed sitting in the bin? Break each of those down, put the amounts that you have and the values of each of those to really break down what you actually have. And then take time to assess the other values of your assets. Look at a true evaluation of what your equipment is. Don't just keep on there what you paid for it. And it'd be depreciation. If you've got a lot of hours on something, make sure you give it a fair value. So equity, take your total assets minus your total liabilities, divide that by your total assets. That's going to give you where your equity is going to be. We see a lot of dairies, especially since 2014, where they started to stress their balance sheet. There was an area of opportunity out there where they started to borrow some more money to put up more barns, update parlors, build new parlors. And we saw that equity drop a little bit. Uh, we saw it sometimes in the mid to low 30s. That gets to be pretty tough because in direct correlation is, I should say, kind of an indirect correlation is the collateral piece of that. Once we see equity get down to that 35%, there's not a lot of collateral availability, meaning that your financial institution being able to utilize some of your assets to borrow against. Where I like to see farms, if you could be 45, 50% or better on equity, that means you've got the ability to borrow. If the marketplace is going to a bad spot, maybe you need to borrow or term out some operating losses, you're not pinned in the corner. You're providing yourself some excess ability to, again, borrow that money and keep your operation going strong. Which brings us into the loan structure. There's lots of different ways to structure loans, and we're not going to go into all of them, obviously, but things to ask yourself is, are your liabilities, are your debts structured accordingly to make sure that you got appropriate cash flow, especially during downturns in the marketplace? So you're looking at your term principal payments, principal and interest payments. Let's throw interest in there as well, per hundredweight. Where should that be? With your debt payments, that's a hard number to change because that's fixed until those debts are paid off. $2.50 or less per hundredweight, that's a pretty good spot to be. Once we start to see north of $3, especially north of $4, that's a number that you can't change. Our feed prices, as important as those are, that's something that we're definitely in control of. Again, once we have debt out there and once it's structured and once we're trying to pay that off, that's a hard number to move. So $2.50 or less, that's a great spot to be at. And your ability to borrow, having availability on lines of credit, operating lines, capital lines of credit, and hedging lines of credit, managing your risk. Having the ability to borrow money when you need it is extremely important. Again, in the volatile marketplaces, when we're going to see an invert with feed and the milk prices, we're going to have a spot where we're going to likely need to see some operating lines utilized again for these dairy producers so that they can keep things rolling when times get tough. Couple of pieces on, I'm definitely not a risk management expert. However, there's lots of different items that you need to realize out there for your business. Again, it's not just forward pricing your milk, your feed stuff. It's beyond that. Obviously, the big thing we all think about is the milk forward pricing, hedging the hedging options, calls, puts, and lots of acronyms out there: DRP, DMC, LGM, MPP when it was around. Lots of different options out there. Understand what those are and how they can benefit your farm and what you want to accomplish. Definitely the risk management side of things on feed and other inputs. Work with your nutritionist, work with your local co-ops. Understand your options as to how you manage those risks. Other pieces, property insurance, life insurance. Here is a big one, business interruption insurance. Wisconsin, Minnesota, the last several years saw several dairy farms get piled up with snow. Huge snow drifts on the buildings. Also, the buildings would collapse, probably kill some young stock, or excuse me, some dairy stock. And now all of a sudden they're sitting in the spot where they can't milk cows until things get rebuilt again. This business interruption insurance essentially pays you some money. The insurance company will pay money in the event you do not have income coming in. Huge deal for the farms that did and did not have it. And especially we're going through some crazy weather with the tornadoes and whatnot that could be coming through the Central Plains, even in the upper Midwest here, where we're just in that time of the year where business interruption insurance could become pretty valuable. Ask an insurance agent about it. It could be extremely beneficial to your farm. And many, many more things. But at the end of the day, be consistent. Manage margins. Try not to just get the best price out there and try to guess correctly. Manage those margins. Understand what your numbers are and make sure that you can hone in on those margins and be consistently profitable. And if you haven't done a lot of risk management in the past, start with a simple plan. Become comfortable, get knowledgeable on the different management options that are out there, and start to get an understanding so that you can do it on a regular basis. Lastly, working with your lender and professional team. Working with a lender who understands your business is extremely important, no matter if you're a dairy farmer or if you run restaurants or any kind of a business. Having them on your side and understanding what the ins and the outs of your business is gets to be extremely crucial. And don't assume that your lender understands all the different benefits of either a project or a change to your business model, operation. If you want to adjust a certain expense area, let them understand, give them the insight as to what it's going to take and what the benefit is of going to be of your cash flow and the overall business standing. Keep your lenders in discussions early. Talk on a regular basis. Make sure that there's no surprises. This will just help in the long term really guide your business into a successful place. On farm meetings, the farms that I work with that have regular quarterly, maybe biannually on-farm team meetings, nutritionists, agronomist, herd manager, lender, so on and so forth, those farms are consistently looking in and honing in on the fine-tuning projects of their farm to make sure that they're doing the best in their interest to be as profitable as possible. And don't be afraid to, whether it be your lender or your other team, walk the facilities, talk about your day-to-day discussion of your business with your professional team. It will prove to have lots of benefits. In conclusion, we talked about a lot of things in a really quick amount of time. Understand your numbers. Again, can't stress that enough. Make sure you understand them and review them on a regular basis. Working capital, setting yourself up with liquidity through the good times so that you can manage through the tough times. Extremely important. Understand your balance sheet. That's going to help you with your loan structuring and understanding where your principal and interest payments are on a per hundredweight basis. Creating the risk management plan that works for you and your business. Identify the different plans that are out there and implement them on a regular basis. Be consistent and be familiar with them. And lastly, lean on your professional team. They're there to help you. The more successful you are, the more successful they will be. Keep them involved on a regular basis. So again, we went through a lot of things in a quick amount of time. I appreciate your time. Kim, thank you so much. I'm going to pass it back off to you and we'll take her from here.
Thank you, Curtis. As far as your crystal ball, and all of the volatility going on in the markets today, at the very least, what are some of your favorite risk management tools or ones that you think producers need to be utilizing at the very least?
Yeah, no, that's a great question. And quite frankly, one of the first questions I'm asking my producers I work with is, what are you working with? You know, DRP, now that that's out there, granted, when we're looking at the cost of a DRP, what the premium is on that, people get a little bit shocked by it because it's today with the volatility and the higher prices that are out there in the futures, we're talking 50 to 60 cents. But when we're looking at the floor that it's being established, we're establishing a floor that is, quite frankly, higher than a lot of our historical prices, almost higher than all of our historical prices when we're looking from an average perspective. So the DRP is a phenomenal tool. Crop insurance. If you don't have crop insurance, I mean, that's a huge piece. And with any of these, whether it's DRP or working on the typical hedging type solutions, calls, puts, where you need to work with a broker, or crop insurance, working with somebody that understands the dairy industry or understands your business in the dairy industry. I think a lot of the tools work. We've got to specifically make it for them. So it's kind of giving you a loaded answer to a loaded question, but no, DRP, and quite frankly, the other thing, working directly with your milk plant, your processor right now. You don't have to lock in all of your milk. Grabbing a couple of this $24, $25 milk while it's out there and hard locking it, class 3 from that perspective, not a bad idea. Not a bad idea.
My thanks to all of you today for joining us and sharing your invaluable expertise and experience. Don't forget to subscribe to the Bova News channel on YouTube, find our Bova News podcast on your favorite listening platform, or find more information at bovanews.com. Thanks for tuning in with us today, and we'll see you next time on another edition of Bova News.